Hi, everyone. Welcome back to the Future of Finance podcast. I'm your host, Marissa Wood with Union Financial Services. And today I'm joined with my business partner, Lisa.
Thanks, Marissa. It's great to be here again. I appreciate the invitation.
And so today we have a fun episode ahead. We're going to be debunking some common investing myths that we've heard clients say. You might even believe some of these myths. And I want to start off this episode by reminding everyone that perception is not always reality. Now, we like to use this example of the yield sign. Think about, what color do you think a yield sign is? Immediately in your brain, when you think yield sign,
Can I answer?
what would you think immediately?
A yield sign is yellow.
I would say so too. The first thought in my brain would be that a yield sign is yellow. That is not, in fact, true. A yield sign has been red since 1971.
Wow.
So, I have no excuse of thinking that a yield sign is yellow because I wasn't even alive. It's been red my entire life. But it goes back to that, perception is not always reality. What we have in our brains might not be the case. And so keep that in mind as we go through all of these myths versus truths, that what you have in the back of your mind might not be in fact true. And so try to keep your mind open as we go through these myths, and I'm sure you'll learn a thing or two.
Great.
Now, the first myth that I want to address is that you need a lot of money to work with a financial advisor.
A lot of people think that. They think, oh, I can't go get a financial advisor's opinion. I don't have enough money. Well, what is that compared to?
Yeah, it's all relative.
Right.
Everyone deserves to have that financial plan, whether it be on, multiple millions or whether that be, your first Roth contribution.
Right. So I like to compare that to getting in shape before you go to the gym. Okay, that's counterproductive.
Yeah, I need to already be in really good shape before I go to the gym. Well, no. Oftentimes we meet with clients that aren't really financially in a great spot, or they have a lot of questions, or they don't feel like they have a ton of education around investing. And that's what our job is, to help them get started.
Right.
And so, no, you don't need to already be wealthy to have a meeting with us.
And you don't need to be good at math to be good at investing. Okay, so we always like to talk about starting early, compounding interest, and it'll be a good place to start to get that initial conversation going and then get that plan going. So we always want to stress that there is never a time that's too late to start, or there's never a time that's too early. There's never the right amount of money. It is whatever you have.
Absolutely. What would you say another myth that you hear super often?
Oh, what we hear a lot of is that annuities will tie up my money. Now, annuities happen to be my favorite investment. So, and I happen to be extremely knowledgeable on annuities. Now, the annuities of today are not the annuities of yesterday. I like to compare things like, is the cell phone of today the same cell phone that was available 20 years ago? The cell phone 20 years ago had a bag and you had to plug it in. Now we have little computers in our hands, and that is the cell phone of today. Well, the annuities of today are amazing investments. They can be short-term. They can be guaranteeing income. They can guarantee other features such as healthcare features. The annuities of yesterday were long-term investments. Today, they are an incredible vehicle that gives you the opportunity to participate in the upside of the market without any risk. And there are withdrawal features now that you can take up to 10 to 30% per year from your annuity. So that that myth of the annuity locking up my money or I don't have access to my money is the annuity of yesterday. That is not true. And if you haven't looked into annuities recently, you might be pleasantly surprised because it's an incredibly great saving vehicle.
And there's so many different types of annuities. You know, you have deferred, you have immediate annuities, you have fixed index, you have variable. And so making any kind of blanket statement around annuities is a myth in and of itself because, you know, which one are you talking about?
Right.
And then which investment carrier, which specific product. There's so many nuances to all of them. But yeah, that locking up my money is
That's a big annuity
one.
myth. And it's time to open up your mind because they are not your grandfather's annuities.
So true. Another thing that I want to address as well is the myth that bonds are a safe investment vehicle and they're safe from market volatility. It's not true. It's just not true. Now, bonds are less risky typically than stocks or mutual funds. They're going to be more of a conservative strategy, but they're not safe from ever losing value. And so, you know, that 60-40 blended portfolio that as you get closer to retirement, you go heavier into bonds and you go less into stocks, which is equity. That was the traditional way of investing for many years. And it doesn't really work anymore. There's too much uncertainty around bonds between, you know, what we're experiencing right now with where do we think interest rates are going to go. There's uncertainty with tariffs, a lot of market volatility. And so, you know, you're marking that bond portion of your portfolio as safe. It's just not true. You know, and so to keep on that annuity conversation, a lot of times, you know, we do still want stock market exposure, of course. We want to have some more aggressive assets, but maybe we replace that bond component of your portfolio with an indexed annuity that truly is safe from market volatility. I don't know anyone that would want their safe money to not actually be safe. That's a crazy strategy.
That's true.
You know?
That is
I
a
want
myth.
my aggressive money to actually yield potentially high results, but I want my safe money to never lose a dime. And so, you know, those target retirement dates, funds, and those, you know, set it and forget it bond equity portfolios, I would say, you know, let's take a look at that and let's review if we can tweak that so that you can still have some upside, but your downside is truly protected.
Sounds good.
Yeah.
So, this is a myth that we hear quite often. I can live and retire on my Social Security check. Now, the average Social Security is between $22,000 and $24,000 a year. Now, maybe in years past, people were living on Social Security because they may have had a pension. Pensions are a thing of the past. Unfortunately, most of us don't have them and have access to it. So what we've experienced in the last few years with inflation, our food prices were something that we never thought we would see, you know, that so much of our earnings are going towards feeding our families. So I don't see that people can live on Social Security alone. A $2,000 a month paycheck is not going to do it. You have all of your bills, and inflation is a real thing. Now, we do have a little bit of a cost of living increase with Social Security, but you know, sometimes years go by and we don't see that. So when people come to us and they tell us that they're going to retire at 62 because that's the time that they can collect Social Security, we have to have a conversation. It's not going to work. First of all, that's a little bit young to be collecting Social Security. You know, you need to give it a few more years at least. And if you're going to continue working, you certainly need to wait until 67 or whatever that age may be for full retirement age. But let's get off the idea that we can retire on our Social Security. It's not going to give us a happy retirement. We're barely going to make it. So either we have to work longer or we have to invest properly ahead of time where we can have some type of guaranteed income that can supplement Social Security. It's just not going to be enough.
Yeah, just because you've reached that age that you think people should retire at or you wanted to retire at doesn't mean that you should.
Because retirement is not an age. It's a number.
Yeah, it's a dollar amount. Yeah, absolutely. That's a huge myth that
retirement is not an age.
Yeah. Yeah. So another one, that I want to address is that, myth of you need to pay off all of your debt before you start investing. We've met with many clients that are obsessed with not having a mortgage. And, I do believe that a happy retirement is one with little to no debt. That's wonderful. We want to have your bills be as low as possible by the time you're at that age. But, especially in younger years, I have friends that, want to pay off their student debt, or they want to pay off a car loan. They want to pay off any other loan they might have, maybe even a mortgage they want to pay off really early before they start investing. But that's doing yourself such a disservice because you're losing out on all those years of compounding interest.
Right.
You're putting that extra $200 a month towards your car payment. But then what happens in the future? Okay, now you just have a car that's depreciated in value.
So true. Paying off debt, of course, if you have credit card debt, that's
story.
One thing. Right. But if you have a 3% mortgage, why are you paying that off early? There's no reason to. You can earn more than that with investing and keeping that mortgage and having the 30-year luxury of paying it over the course of all those years and having your other money work for you. Paying off debt is probably it's a mental stigma that people can't get rid of.
Yeah.
You have to understand,
hangs over our head,
but it
debt
shouldn't hang over.
Yeah.
We're all going to have debt at all different times of our lives. Sometimes the debt might be overwhelming. Well, at that point, what you need to do is work on a budget. But debt is not always bad. Good debt is low mortgage rates. Good debt is maybe a student loan that you have X amount of years to pay off. And use your other money wisely to make it work for you.
Yeah, the one thing that is the biggest benefit in investing is time. And so, starting as early as possible, regardless of the dollar amount, you want to have those years of earning potential and compounding interest. And so, waiting until 20 years from now when you're debt-free to start, it's not going to do it. You lost those 20 years of interest. And yes, now you have an asset, but if all you have is your house, your house rich and your cash poor,
Right.
You don't want to retire with no investments and just a house, because how are you buying food? How are you traveling? How are you paying for, your grandchild's Christmas present? You can't pay for that with a house.
No, and people always say, well, real estate is a great investment, which it is.
Not until you sell it.
Not until you sell it, and then where are you going to live? We're in a funny place right now with real estate, because if you sold something, well, even if you downsize, you're probably it's going to be a lateral move.
Because of the interest rates.
Yeah, you're not really going to have that big wad of cash that people seem to think. So some debt is good. Debt is fine as long as you can manage it, and credit card debt is not good.
No.
That's the only debt that
because
I don't.
Those kind of interest rates, what, 20, 25%?
21, yeah, sure.
You're not
Sure.
going to average
No,
that in
no.
the stock market on a normal year.
So let's talk about your debt. Let's see where the smarter debt will be, or the easier debt, and then we can move forward with a plan.
Absolutely. Now, our next myth I'm going to let you take, because I know it's a passion of yours, and that is, the topic of long-term care.
Right. It's a passion of mine, because so many of my friends and so many people in my family, including myself, have dealt with relatives or loved ones that have gone through long-term care events, medical events that maybe drug on for years, that maybe financially drained the family, the one that was left over, maybe the spouse. That spouse is now struggling because his wife pretty much had to go through all their savings in order to make her life comfortable, and inevitably, it does end. And then where does that leave the other family member? Sometimes it leaves them devastated financially, emotionally, of course. So because I have lived it myself with a family member, I have so many friends that have gone through this, that when the insurance companies came out with investments that will help cover those long-term care events, and I'm not talking about a standalone long-term care policy. They're sometimes very difficult to get, and they can be expensive. I'm talking about an investment with long-term care features built in. When the insurance companies came out with that quite a few years ago, my eyes lit up. My heart opened up, because this is an answer. This is a solution. This can help so many people. And I have multiple policies like that for my own self. I want to be able to pay for my care. I want to be able to direct it. I don't want to be a burden on my family. I don't want to be that financial burden. And when someone's going through a long-term care event, it's not just a financial burden. It is people putting their lives on hold, family members usually, and it's an emotional, it's draining. So when people come to us and they tell us that Medicare is going to cover their long-term care, that is a big myth. Medicare will not. We wouldn't have a Medicare system.
No, it would be
stone cold
broke.
If it was caring for people, into their 90s or 100 years old, it just would never be able to sustain that. So Medicare will cover your hospital bill, your doctor bill, surgeries, but it does not go into any type of extended care. It will never cover any of that. It will cover the medical portion, maybe medicines, but people
I think
need
what
to.
they're thinking of, and maybe confusing it with, is Medicaid.
So Medicaid is totally
which
different.
Is entirely different, and you do not want to be on Medicaid.
No.
Because to be on Medicaid, you have to have a net worth of $2,000 or less.
Yeah.
That's worst case scenario. That is not a plan.
That's not a plan. No, that is, unfortunately, people sometimes find themselves having to go on Medicaid, and it's not the most pleasant environment to be in. The treatment is usually government-run facilities, and it's not what most of us would want for our end-of-life days. So let's have a conversation. If people need some type of added money to pay for care, we never know. But it can be there as that safety net, and it can be an investment, because Medicare is not going to cover it.
So true. Yeah, thank you for sharing that. Now, shifting gears a little bit, I want to talk about a myth or two regarding the stock market. And myth number one is that you should sell when the market is in trouble. Huge mistake. We all know the buy low, sell high philosophy, and that's how you make money in the stock market. And so, why would you sell when it's low? And it's the reason why is it's an emotional thing. We hate seeing, so much of our money we feel like running through our fingertips, even though it's not, it's not a legitimate gain or loss until you actually do make that sale. But instinctively, we want to cash out when we see the market starting to go down. And then what does everyone want to do when we're having a great year in the economy, the 2017s of the world? I got to get in the market. I'm getting in the market. I'm buying in. Okay, well, you're buying high. That's not as big of a mistake as selling low. But part 2 of that myth is that if I lose 25%, I just need to make 25% again to get back even. We are mathematicians, but that's simple math, and it's not true. If you lose 25% in the market, and you make a sale or whatever the case may be, the true return that you actually need to get back to where you started is 34%.
And why is that?
Well, let's think about it. If you have 100,000 and you lose 25%, now you're down to 75,000. Now, 25% of 75,000 is not going to get you back to that 100 because it's based on a smaller number now. Mm-hmm. You actually need 34% to get you back to that 100.
When have you seen the market come back at 34%?
Hardly ever. I mean, the S&P's average rate of return throughout the last 30 years is about 9% a year. And so, those years where we see 20, 25, 30, 35%, they do happen, but they're not the norm. And, it goes back to, obviously, you don't want to make a sale when the market is down and then, wait to get back into the market until it's up again. That's a terrible mistake. But, you also don't want to stay in the market when you're approaching or in retirement. You don't want to have all of your money in the market, because if you experience that kind of loss and couple it up with, a withdrawal that you're using to pay your bills, the reality is it's going to be a really hard time to get back to where you started. And you don't want to be climbing out of that hole, especially in retirement. It's all about having that diversified plan. We don't want to have 100% exposed to market volatility, and we don't want to have 100% in a totally safe investment either. We want to have a nice blend and adjust that as we go through our life.
Right. Once again, you need a professional to help you along the way.
Yeah.
Because every stage of life is different.
Mm-hmm.
Every stage requires different types of investments. And to go alone to do that is sometimes a little daunting.
Mm-hmm. Yeah. And strategies need to change over time too. Mm-hmm. That accumulation phase, maybe, the strategies that you've had, the investments you've had have worked really well. But once you cross over into that distribution phase of your life, when you are retired and you're no longer putting that money away, you're actually pulling it out, that strategy needs to be totally different.
And that's so contrary to what our minds have taught us over the years. We're so used to saving, accumulating, building that nest egg, climbing that mountain. Mm-hmm. And then when we have to go down the other side of the mountain, mm-hmm. it can be extremely challenging. And it can be frightening.
I think hikers would agree with that too.
Right.
Going down the mountain is probably more dangerous.
Mm-hmm.
If
you need a little help going down that mountain, mm-hmm. and being able to take a slow and steady pace, mm-hmm. so that you don't run out and fall.
Mm-hmm.
Mm-hmm. No. Recently we've had some decent rates with high yield savings accounts, mm-hmm. and that's wonderful. And they probably will be changing soon. So now is the time to talk about how safe is it to have your money in the bank?
Because the myth is that the bank is the safest place for my money.
Right.
Besides underneath my mattress.
Right. So now we all know about the Great Depression. Yes, it was many, many years ago. But during the Great Depression, the banks failed. People went to go withdraw their money, and the banks did not have enough money, mm-hmm. to pay out all their customers. So that was a big problem. Now, in came the FDIC many years ago, And the FDIC is an insurance company, and it will insure each individual for $250,000. Now, that $250,000 can be in savings. It can be it will be an accumulation of all of your accounts, whether you have CDs, savings account, checking account. The max you are insured for is $250,000. And the bank has many, many years to pay you back that $250,000 if, in fact, the bank would fold. Now, highly unlikely because there are so many other banks that would take over and bail out. I mean, it's probably never going to happen again. I hope it will never happen again. But let's get back to that FDIC. That is an insurance company. We like to go directly to the insurance company with our investments because we know that insurance company is solvent. They are scrutinized on a daily basis. And so having your money invested with an insurance company is pretty smart.
Yeah, I mean, the insurance companies are the ones that really got us out of the Depression.
Yes.
They were the only companies that survived the Depression, kind of thrived, actually. And, to be able to go right to the source and maybe cut out that middleman and, go right to the only thing that is adding protection to the banks, which is the insurance company. Yeah, I'm just going to go straight to the source with a portion of my money. Obviously, you have to keep some in the bank, and you have to, have your checking account for your bills and whatnot. And I like taking advantage of a high yield savings account as well. But you don't want to have all of your money in the bank.
No.
That is not safe.
No.
And that is a myth.
It is a myth. And this is just a little tip that is alongside, speaking of banks. Your bank account needs a beneficiary or multiple beneficiaries. Banks do not ask you when you open an account. Our bank does not anyway. Most people that I tell this to, they say, I don't think I have a beneficiary on my bank account.
They call it a TOD form, right? Transfer on death.
Yeah. Go to the bank and add your beneficiary because if you die and you have that $250,000 in the bank account or in multiple bank accounts, that will wind up in probate. You need to add it. And so many people that we speak to don't have one on there. And after meeting with us, they say, I went to my bank and guess what? I didn't have a beneficiary. So
if you take one thing from this episode,
just a little tip.
Do that.
It's very important.
Yeah.
And I was shocked because I got caught in that. And I pride myself on being very, very studious with my beneficiaries. I did not have a beneficiary on my bank account. I do now.
Yeah. Yeah, that's a really good tip. All right. So I want to go through two more myths. And, this one is that it's pretty common, and you might be thinking it yourself while you're listening to this, and that is that life insurance is only for wage earners.
Say if there is a stay-at-home mom that has 3 kids, age 1, 3, and 5. They are all at home with that mom. Now, what if something tragic happens to that mom and she passes away? Well, that father now has to pay for childcare, pay for someone to handle all the household duties. There is a definite monetary price on all of those chores that stay-at-home mom does, including the childcare, which is expensive. I mean, tens of thousands of dollars we hear for a month.
The average daycare is about $10,000 a year
per
per
year?
child.
Per child, okay.
And that's just the average. I mean, depending on which state you're in. And then even when they go to school, well, you might need tutoring, you might need transportation to and from school. I mean, the cooking, the cleaning, the laundry, it goes on and on. Just because in your mind there was no monetary value does not mean that is true.
Just because there was no paycheck coming in But when that money has to go out, it needs to come from somewhere. So both parents need to be covered with life insurance.
Yeah, maybe not equal amounts, but let's talk about what amount makes sense. And part two of that myth is that I have enough coverage already through my workplace insurance. Oftentimes that is only 1, maybe 2 times your salary. And so then what?
What happens when you leave that job?
That too. I mean, first of all, I don't even think it's enough to begin with.
Right.
Because 1 or 2 times your salary is not going to take care of your family very long.
Right.
But then, if you leave that job in your 40s or 50s or 60s and you're no longer insurable, you lost your life insurance and you might not be able to get approved for one on your own, or it's too expensive at that point. So just because you have a benefit through work doesn't mean it's sufficient.
Right. So there are a lot of myths surrounding life insurance.
A lot.
We can talk about it for an hour.
Yeah, we could. Yeah, absolutely.
We won't.
No.
Okay.
And so then the last one I want to touch on today is kind of also in that same conversation of your employer, but that's the myth that my former employer is managing my 401k.
Your former
My former employer.
Oh, so
I
when
left
you
the
leave
job,
a job,
but it's with Voya or it's with Vanguard or Empower, and I had a good relationship with the employer and the HR department, and it's done really well so far, and so I'm just going to leave it there. They're managing it.
That's a big myth, and that's a
Huge.
big mistake. There, on many levels. We meet with too many people that have multiple 401ks with former employers, and they don't know where they are. They have no idea what the cost is to have that 401k still with that company. They have no idea what the performance is. And do you really think that someone in that office is concerned with a former employee's 401k? Are they actively managing it?
No.
No.
Are they calling you to make sure that your beneficiaries are updated, that your address is always updated? No, of course not.
No. It's kind of in that dead file. It's just off to the wayside, and it's not really doing you any good. You need to consolidate all of your 401ks from previous employers, and you can put that right into an IRA where you have control, you have choices, you have benefits that may not be available in any other plan. So let's not leave those 401ks.
No matter how good you think the performance is, and even if you like the funds it's invested in, oftentimes when we meet with clients and we open up that individual retirement account, IRA, we can move the funds over from your 401k, and if you want to keep those same Vanguard funds or, whatever the holdings are, it can be moved like to like, but now you at least have eyes on it. We might be able to lower the fees because, 401ks carry fees.
Right.
And you have more choices if and when you do want to make changes. And so it's a no-brainer. Like, you should never leave a 401k behind when you leave a job.
Right. And just once again, it's a simple process.
Yeah.
And that's probably the number one reason that people don't do it.
We do all the work.
They think they have to call their former boss.
Yeah.
They do not.
No.
This is taken care of company to company, and it's a very easy process. And like you said, we do it.
Yeah, and we don't charge to do it. It's a very seamless process that we do all day long. But I would say, that is a huge myth and a huge mistake, and one that can easily be resolved. So if you're thinking right now, well, I did leave that employer years ago, what happened to that investment, even if it's only a couple thousand in there, let's have that conversation and help you out with that.
Right. So with all of these myths, I think that there's probably one or two that a few of our listeners have said, I think that's me doing that. Or I think that was what I believed. And hopefully we can maybe make some progress in just explaining some things and helping you out with maybe some of these questions that you didn't know to ask or that you thought weren't proper to ask. There's no silly question. There's no myth that is so unbelievable. You're not alone in believing these things. So let's have a conversation.
Yeah. I mean, and I guarantee you're all going to laugh now next time you see a yield sign. You're going to take a closer look at it and you're going to laugh and you're going to say, you know what? Yeah, not everything I believe is always true.
That's great.
So, you know, it was a fun episode to have. Lisa, thank you again for coming on.
Always.
It's always a great time.
Thank you.
And, you know, I love working side by side with you with our clients every day.
As do I.
And for everyone listening, if you have a question that you would like answered or something today sparked your interest, feel free to go to our website, union-financial.com. You can click schedule a meeting and that'll take you right to our personal calendar where you can book a time to have a conversation with either myself or Lisa. And for everyone watching, we look forward to seeing you again on the next episode of the Future of Finance podcast. And we can't wait to help you live a better financial future. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.